drawing very quickly. If you bought a house for $400,000 and paid $20,000 in down payment and the rest you borrowed, here is ignoring interest and other things. What happens when the house price goes up? You owe the same amount, or with interest. I'm not really complicating the matter, but all the increase of 2.5% the value of the house actually gave you a 50% increase in your equity portion of it. So in percentage wise, it's great on the small base. If the house went up by 5%, you double your $20,000 because you benefit from the entire gain. So it juices up, it magnifies the returns on the upside. The house goes up by 10%. That is the $40,000 that now gets added to the $20,000. So you tripled your initial money. So this works really wonderful. That magnifies the upside. You put a little bit of money and you get to do a lot more. Buy a big house. However, it looks very ugly on the downside. So if there's a small decrease in the value of the house in this case, of course, could also be reasons that you will not be able to pay your debt. That's a different thing because you lost your job or whatever. So all the promises that we make, but here is just the value of the house against which you borrowed. You lost half your equity for just a small decline in the value of the house. This was sort of the subprime crisis in the US. 20,000, 5% decrease in the value of the house wipes out your mortgage. And this is a situation called being underwater, which means that the house is worth 280, but the house is worth, 360, and you owe 380. So you are underwater, meaning if you sold the house, you couldn't pay your debt. So that is going to be akin to insolvency for corporations. Now let's talk about banks. Banks have deposits, which is colored red. Everybody forgets that, but they do owe us back the money. It just doesn't feel to it as it to them, and I'll come to that in a second. And we can take that money that they owe us anytime we want in the ATM, so we count on that. But they build a big tower of red debt that they owe. And of course, they might put it at risk. And what happens if they lose? So they put a teeny bit of equity under this. And of course, here's what can happen should they lose. What can happen, since they're very interconnected, is they will start a contagion mechanism, which, is dominoes of some sort through the contractual relations they have with one another and through other mechanisms of panic and fear and whatever else. And here we have a financial crisis, and here we have, this is Uncle Sam, governments and central banks and people standing behind them, propping up the system and trying to save us from it collapsing. And that was basically, in a few minutes, what we have experienced sort of a decade ago and, way back in the history. But here's what happens. Now, color-wise, in the codes, I come from Silicon Valley, and here in the big tech companies, they don't bother to borrow. They just have a lot of profits, and they mostly fund with equity here, and they don't need to borrow now. They don't have a business of providing liquidity and deposits, but still, the difference is so stark. What is wrong with Google that it has so much equity? Why is it having this equity that the banks say is so expensive to have, and all of that? Now, I want to stop and mention that when you talk about things like balance sheets, I didn't draw it, I just color-coded sort of assets and liabilities. Central banks are very different. Central banks are not normal corporations. They don't have normal balance sheets. People talk about their balance sheets, but they just can make it. So they print that currency, the paper money of central bank money that we used to pay. And that is very special because the central bank is not going to default on the currency. It can print more of it. So this is a very unusual institution. It's not a private corporation. However, anything else we could think about as this loaded word money is somebody's debt. Our deposits, our credit cards, everything we use, there's somewhere somebody owes somebody something. And the economy is built on IOUs. So central banks are special, but the rest of us build that. Now, I will summarize to you this big debate that I've been involved in for more than a decade now about equity for banking, the green stuff, okay? The bottom line on this green stuff is that the banks hate it. and have as little of it as possible. So they want to only make investments on money that they owe somebody, which they will not default because somebody will prevent their default, the central banks or the government. And they meanwhile can take that upside that's magnified. And so they get compensated to gamble, and they get tax subsidies and others, and they can shift the costs and risks to other people. And so it's pretty clear from their perspective why they hate equity. They have particular way in which their creditors, including depositors, are very easy on them, and therefore they can do it. From society's perspective, the fact that the banks have so little equity by historical standards or by any standards you can think about, and nothing to justify that, is just that is bad. And so there's nothing good about it at the levels that we have it, which is really outrageously inadequate levels. And then there's the measurement issues I'll get to. But everything good can happen if they just have more equity funding, more green stuff to do all the stuff they need to do, support the economy. Everything they do will be better. The liquidity they provide will be safer. They won't need as much support. They'll make fewer bad decisions, all of that. So I need to introduce you to the concept that's very important in the whole discussion of corporate debt, even small business debt, the concept of a zombie, the concept of insolvency. It's sort of like the underwater homeowner. It's a very tricky thing to identify when somebody is a zombie, because you can default on your debt, but maybe you're insolvent. And that's a much trickier thing as long as you pay your debt, which is sort of the permanent state of banking, is sort of high distress or insolvency, a big overhang of debt. So there are symptoms. This says don't open, dead inside. And this is important. I'm not showing you zombies because it's very unpleasant to see zombies, but they have symptoms. A zombie institution, a corporation that can issue equity, cannot find people to give it equity if it issues a piece of paper called equity shares. People don't want to give it because it's very weak, and the debt will have to be paid, and there won't be enough left. They start having a lot of biases in favor of taking a lot of risk, because the upside they can take and the downside they just walk away from in bankruptcy or whatever, or somebody comes in to help them. They're anxious to take the cash out, which is to pay it out to themselves, to the managers, to the shareholders. They avoid equity if they can possibly lobby against it. They sell assets even at fire sale prices. I've done a lot of research on the responses to all kinds of ratio requirements and other things. It's all technical, as was said, but it's not that hard if you get there. And they hate the boring projects, because the boring projects go to the creditors, and they will underinvest in those business loans in favor of all kinds of other things, depending on the regulation, depending on all kinds of things. And they try to hide it in their disclosures to just live another day and lobby the policymakers to just keep persisting in this unhealthy state. Here's a study from just over a year ago about zombie firms. So companies that are very weak, have a lot of, and they produce non-performing loans that are not paying the banks, and their connections to weak banks. So the zombie banks tend to keep alive zombie inefficient institutions and even crowd out some healthier business that they should have funded. So that these investments get very distorted, and the system is not producing what we want when we have a lot of zombie banks and a lot of institutions that are really not viable throughout the economy. And it can really harm growth, it can cause recession, all of that. So a lot of that overhang is not good. Now, the regulations that are supposed to take care of it are written up in Basel, in the Basel Committee for Bank Supervision. And the Basel II, with which we entered the last financial crisis, was a spectacular failure. And I can go on and on that. And the Basel III that's supposed to save us is barely a tweak. And maybe one quote on it is a well-intended illusion. So they trick you into thinking, oh, it's so much better. We did so much. We tweaked, this screw and that screw. Bottom line is it's really a disastrous reform, however much it's a little bit of a reform. And I'll just illustrate it with one example of the Greek crisis, which has its own points, because this bad regulation matters a lot to people. And it mattered a lot to the people of Greece, as well as to the people of the lender countries, which were, as you can see in this graph, the citizens ultimately of France and Germany in particular, whose banks were the lenders to Greece. So what you can see here is who lent to the Greek government, which was like a subprime homeowner, not a very prudent borrower, but we have to ask who the lenders were. The lenders were the private banks in France and Germany primarily, and in lots of other countries. In 2009, the Swiss banks left, sold all their Greek government bonds, but the French and other banks stayed there. And in between, when Greece was finally allowed to restructure and default on a little bit of its debt, there were multiple bailouts. What that meant was that Greece was being given money so that it can pay back its debt to the French and German banks and other creditors at high interest rates, so that we won't have more failures of French and German banks, because then we'd have to bail them out, and we just finished bailing them out. So we rolled into a crisis in which the hidden bailouts were really supposedly given to the lazy Greeks that borrowed too much, but in fact went to the reckless institutions to a large degree for a while, which made those bad loans and didn't absorb the losses. So the French banks owned 40% of the Greek government debt in 2010. And the regulation, this same regulation that Basel devised, are counting lending to governments in Europe as if it's riskless. It gives it zero risk weights, which means that you can ignore it as if it was good as cash. So that's how crazy this gets, is that the regulation decides what's risky and what's not risky. And if it decided that it's not risky, then suddenly you can ignore the risk. And you can lend as much as you want and get all this spread that you can get. So in 2015, when we entered a very intense summer of almost having Grexit, who owned the Greek government bond? Well, in blue here, you see the citizens of Europe, meaning the German citizens, not in green the German banks, and certainly not the French banks, which were all pretty much out, but in the bailout funds of the European bailout, the total fund that ended up buying all this debt and assuming all this debt, countries contributed based on their size. And these were countries that were already had troubles in some cases, like Italy, that suddenly had to bear the risk of Greece default. And of course, two institutions, IMF and ECB, that also took on some of this debt. And that ended up, the Troika, the official creditors of Greece, ended up being very, very harsh on Greece. And we know that that caused a major depression in Greece and all kinds of conditions. And which was a big crisis, okay, which we're sort of not hearing about as much in the news. Now, they'll tell you also in the regulation, so I need to go quickly here, that they created a clever bail-in. So instead of bail-out, we're going to have bail-in. The problem is they don't press that right button that some of them would tell you they have to cause the investors, meaning the creditors, to suddenly lose. Not the shareholders who automatically lose when there's a loss, but they will trigger some bail-in, except for the problem that they just don't. So here's January of this year, and governments in Europe are still finding workarounds to bail out their banks. So again, either you sold the bail-in debt to somebody, a retail investor in Italy, and they're going to kill themselves because they didn't realize that they were supposed to absorb losses of, Monte dei Paschi or some other sick bank. But somehow the governments don't like to let the banks fail or their investors to lose, because somebody is going to lose. And so they choose this yellow button, the smiley face save button. That's what they always choose in the end. Now, this is a paper from 2018. I'm moving to the fact that we don't even know what's inside the bank. So that's the don't open debt inside, because the disclosures are so poor. This is a 2018 paper that says that we can't even estimate the indebtedness, the leverage of the banks. Off-balance sheet funding that's not even reported well, that's not even counted as much, is higher now than in 2007, before the other financial crisis. And this is a recent paper from IMF, okay? Here